Well, with Washington reining in Chinese moneymakers, should you be concerned if your retirement is invested on Wall Street? With more details on that, I'm joined now by Brian Tycangco, analyst on True Wealth Opportunities China. Brian, thanks for coming.
Thank you, Jessica.
So the SEC is proposing another round of rules to delist companies which do not meet their auditing requirements. We saw this conversation begin over the summer, and since we've seen further crackdowns on Chinese equities, including an executive order from President Trump telling anyone connected to the Chinese military, that they will no longer be eligible to be listed on these exchanges. What is likely to be the impact on U.S. investors of such a proposal?
Okay, so right now we're not yet so sure of the impact since we have no idea yet exactly when this will be put into effect. The whole issue about the SEC bearing down on these Chinese companies listed in the U.S. now stems all the way back to March when a U.S. listed company called Luckin Coffee encountered an accounting scandal that turned a $15 billion company into basically a sub $1 billion company almost overnight. This basically started a whole effort to rein in basically what they call erring Chinese companies that still refuse to have their books audited by the Public Company Accounting Oversight Board, or the PCAOB. In July, Congress passed what they call the Holding Foreign Companies Accountable Act. And in this act, they state that companies who still fail to comply with the PCAOB will be delisted by January of 2022.
So let's back up and say, and ask this question, Brian. Brian, how much of Wall Street is actually made up of Chinese equities?
Chinese equities listed in Wall Street have a total combined market cap of an estimated $2 trillion. That's about 5%, 5 to 6% of the total market cap of the New York Stock Exchange and NASDAQ combined.
What does that tell you about the exposure that the average American investor has to Chinese equities?
I think the average American investor has significant exposure, not tremendous, not overweight, but a lot of American investors don't even know that they're exposed to a lot of these Chinese stocks because they invest in things like ETFs. And a lot of these ETFs, not just the China-focused ETFs, but ETFs like technology dividend ETFs have investments in companies like China Mobile, which was included in the recent executive order that broadened the scope of Chinese companies thought of as linked to the Chinese military. So imagine that China Mobile, if you can't invest in China Mobile, it's going to screw up the entire weighting or the entire portfolio of certain ETFs that many investors in the US probably own.
Okay, so there's probably a lot of investors who are just finding out, that are watching right now, that they might be affected by all of this regulation that's happening in the final waning hours of the Trump administration. You mentioned earlier that basically the SEC turns over its directorship with the administration. So we know that the end of this year, the head of the SEC, which is making these rules, is going to leave, and that Joe Biden, the incoming president, is going to appoint somebody new. So walk us through again, what is the point of coming up with a regulation this late in the game that could impact as many Americans as we're talking about? And we don't have a number, but it's probably a lot more exposure than people realize.
Exactly. I mean, the point here is really to force the next administration to address these issues raised by the current administration. From where I stand, I see that this will continue in the next administration, and that the volatility related to such moves will not go away. However, there's already been news of the SFC of Hong Kong actually agreeing sort of in principle with the Chinese Securities Commission and the Ministry of Finance to allow oversight of the accounting or the books of Chinese companies listed in Hong Kong.
That sounds like an effort to meet the criteria that these Chinese equities have to be audited by some of the big auditing firms and meet US standards, but that the auditing will actually be done in Hong Kong. and according to Hong Kong standards.
It hasn't been implemented yet, but that looks like it could be forming that way. It might be setting up that way. At least it now leaves an avenue to actually open up the lines of communication to really comply with these requirements. And I think that's a positive.
How does that affect the investors that are invested in these equities? Will they be able to stay in them without any noticeable difference?
You know, I really can't tell. I mean, how U.S. policy will be formed regarding this afterwards. But right now, it looks like U.S. listed Chinese companies can stay listed. The biggest losers of such moves to be delisting $2 trillion worth of Chinese stocks from the U.S. market are really the U.S. investors.
All right. Well, thanks so much, Brian Tycangco, always giving us the tip of the spear there in Asia and in Chinese equities. Thanks for coming in.
You're welcome.
And if you'd like to catch up with any more Stansberry Research content, please take a look at all of these social media platforms where you can find us. That's all for now. Thanks for watching. I'm Jessica Stone.